Welcome everybody to this Hardman Investor Forum. My name is Keith Hiscock and I'm the Chief Executive of Hardman Co. These forums give investors the chance to hear a company's or a fund's investment case and question the management. And today we've got 4 presentations. The first one comes from ICG Enterprise Trust. This trust provides investors with a chance to invest in private equity through a public vehicle traded on the stock market. In the past, only big institutions and family offices really had access to this pool of assets. ICGT gives ordinary investors, every sort of investor, the chance to access this pool of investors and the pool of assets, and it brings liquidity to a space that's naturally rather illiquid. You'll see on the screen a quick summary of the shareholders. So the biggest shareholder is Bank of Montreal, 870 million market cap, a decent yield. The chart you see in front of you shows the discount to the NAV. You'll see that the line running through shows that we're trading a greater than 20% discount to NAV at the moment. So not only does this give you access to an interesting set of assets, it's quite otherwise difficult to get access to. You can do so at a discount to NAV. Now, we're very lucky today to have 2 speakers from ICG Enterprise. Oliver Gardy, who's the head of private equity fund investments, and Colin Walsh, who's managing director. Gentlemen, over to you.
Thanks for the great introduction. I just wanted to say thanks for everybody. It's a great pleasure that you are attending the conference, and it's a great pleasure to be invited to the conference. Keith has already done a great job introducing us, and our mission is really, and that's why the title that you see here is what ICG Enterprise Trust is all about, is democratizing private equity. 20, 30 years ago, private equity was just a niche asset class, which only a very few privileged investors, such as ultra-high net worth families, sovereign wealth funds, or large pension funds had access to. Today, this little niche investment strategy has grown to an established asset class with exposure to all sectors within the economy. As a matter of fact, in the UK today, there are about twice as many companies owned by private equity funds than the amount of companies listed on the UK stock exchange. However, there is a big issue getting good access to private equity investments, which has been notoriously difficult for small institutional and retail shareholders. And we'll talk about how do we structure and how we design to kind of get around those issues. And as I said before, our mission is to democratize private equity. So everything we have done here with the private equity trust in terms of investment strategy, as well as the structure, it's all dedicated and designed for retail investors as well as small institutional shareholders to have access to private equity without the issues private equity has in terms of, for example, liquidity and some of the risk behind it. And I hope after this presentation, you will understand what we've done to make private equity attractive for retail shareholders. And effectively, what we're doing is we're providing our shareholders with the greatest hits of private equity, or the best of private equity. With that, I would like to go straight into the first slide. Many of you probably have seen that private equity has outperformed over long term all other asset classes. Not has it just outperformed, it's outperformed it significantly across all other asset classes. The industry today is 6 trillion assets globally, so it's getting to quite a important size. Still significantly small enough to provide good returns and alpha compared to other assets in the investment world. The challenge for private equity, however, is that you need to get really selection, and access really matters. As you see here in private equity, there is a large dispersion, and it's probably the largest dispersion of any other asset class between the top quartile performing managers and the bottom quartile performing managers. Or phrased differently, if you're getting access and you can select the top performing managers, you're getting great returns in 15 to 20% IRR. And that is really important because that's obviously for small institutional shareholders and retail shareholders. Even if you can select and you know which managers you should be invested in, getting access is very difficult because those managers are typically oversubscribed, and the minimum ticket to participate is somewhere around 10 to 15 million. ICG, and we'll talk about it, how we get access to it. But our being 40 years in this industry, we obviously know all the managers. We are part of the community. We're part of the fabric, and we have the selection tools and the analysis and the team to get our investors access to the top quartile managers. Moving on to the next slide. Why is private equity outperforming all other asset classes? It's pretty simple. It's actually the active ownership model really drives the outperformance. It's being able to actively drive strategic change, operational improvements, and also installing financial discipline through internal house capital markets expertise, and providing not just capital markets, but also sector expertise, certain management expertise, and follow-on capital really allows private equity to buy good companies and make them transform them into better companies. And a lot has to do that with being able to operate and invest patiently. It's long-term capital. Private equity is not bound by quarterly results and need to show their shareholders improvement quarter on quarter. It's really what matters is what you've done over 5 years and how much value have you created over a 4 to 6 year period. Alignment of interest is a key component of outperformance. In private equity, the private equity investors, as well as the management team, are heavily incentivized by the equity, their value they're creating, and usually, and it's heavily skewed towards that. So you become wealthy, or you make a great contribution to compensation is at the point in time when you realize the exits, rather than on unrealized paper profits. So there's a high incentive to actually create exits and proceeds on a realized basis. Why is it difficult for retail investors to invest in private equity? First of all, is what we've talked about is already access. And as I showed you in the previous slide, selection really matters. And therefore, you need to have the team and the resources, as well as the relationships, to kind of get access to those top tier managers. And that's what we can provide for our shareholders, because we've done this business for over 40 years. And you will see in the portfolio and the performance that we have that we can consistently on a sustainable basis provide that. The other challenge for retail investors is it needs a lot of capital to kind of build a diversified portfolio, because typically the top tier managers, they can dictate who they would like to have as an investor. And typically they don't pick up tickets lower than 10 to 20 million pounds. So it takes, in order for a retail investor to get a good diversified portfolio, or any investor get a good diversified private equity portfolio, you're talking about hundreds of millions of pounds you need to have, which is obviously very difficult for a retail investor. So we can break that down, because we can provide that we can provide those type of investments to our managers. A key point is liquidity. It takes a long time in private equity till the capital is invested and until it's realized. So typically it takes about 7 to 8 years until the complete circle has come around, where you have invested in the fund and invested in the investments, and until they have been realized. So from the realized proceeds, you can then start reinvesting again in private equity. Versus what the Enterprise Trust does for you, the retail investors, is it has already a ready-made portfolio which is in full cycle. So it constantly makes new investments as well as gets realizations and distributions. So the portfolio is already fully put together. And lastly, and very importantly, obviously, the liquidity of the share is entirely unconnected from the liquidity of underlying portfolio. So anyone can buy today a share of Enterprise Trust and sell it in the afternoon or a couple of days later or whenever the individual would like to sell their shares in ICG Enterprise Trust. So it provides daily liquidity. And then lastly, investing in private equity is loaded with a lot of administrative burden, KYCs and so forth. We all do this with our team for our shareholders. So we do not have to, our retail shareholders don't have to bother with that. It's a very easy purchase, just purchasing a share on the stock market. I won't spend too much time here because we'll use that as a summary. But I think what we would like to give you here comfort is that we have a lot of experience. We've been doing this for 40 years, and we're a long-term investor. We have a very clear purpose, which is all about, and everything is designed to really democratize private equity and to give our investors the greatest hits of private equity. And we've been benefiting from a unique access of the ICG platform, which is one of the largest private markets investor in Europe. And so we have a lot of insight into the private equity managers, into the portfolios, which helps us in picking the right investments and the right funds. And that all, having those components work together really generates consistently strong returns. So we've had 12 consecutive years of double-digit portfolio growth, and we are expecting a 13th. 2021 looks very strong, and we're expecting a 13 consecutive years of double-digit portfolio growth. Now we should talk about, on the next slide, about our strategy and how it's specifically designed and structured for small institutional and retail shareholders. So private equity has great returns, and as we said before, it outperforms any other asset class. But it does have that inherent risk and illiquidity, so one has to be careful how you actually invest your capital. And so we are very, very focused on providing our investors private equity type of returns, but with much lower risk and much higher liquidity. And so therefore, we're very focused in our investment strategy to provide the best risk-adjusted returns. And how we generate them, this is a key slide. So when you look at the first four little filters and bars here, those are all created and designed in order to take risk out of private equity. So we invest only in buyouts. Why? Because buyouts have much lower loss ratios than typical venture capital or growth capital, where you're looking at loss ratios of 65 to 70% versus in buyout, it's somewhere around, the top tier funds are somewhere around 10 to 15% loss ratios. We only focused on developed markets because that's where the depth is of assets and capital and liquidity, where you have functioning stock markets, functioning strategic investors who have interest in deals, and that's why you get good liquidity. So only US and Europe buyouts is where we're focused on. And within that buyout sector, we are focusing on the mid to larger deals and the mid-market to large funds, because those are the funds managers where they have the resources. That's where you find they are big enough that they can afford having teams, big teams on their roster who help also not just to buy a business, but then also help in the transformation of the business. So they would have sector experts, they would have experts on purchasing, supply chain experts, as well as capital market experts. So we're looking for teams who are very resourceful, and typically you find them only in mid to larger fund managers. And so that reduces also the risk. Now, the last two filters is really all about how we're driving revenue and how we're driving growth and how we're driving returns. So we're only focusing on top tier managers. I won't repeat why. You've seen the slide, why we're only focusing on them, because they also consistently and sustainable get the best returns. And then we're also focusing on defensive growth. So we're looking for companies who are, and Colin will talk about it in more detail, we're looking for companies specifically who are defensive and resilient during cycles and down cycles, because they have a particular strong reputation, a brand, technology, or processing cost efficiencies or are cost leaders. And that's so they can weather through cycles, but are in sectors and industry where there's strong growth and continues to be strong growth. And those are the type of businesses we like and sectors we like to invest in. With that, I pass it on to Colm to give a bit more, put the portfolio and the deals and what I've just talked about, our overall investment strategy and approach, to put it to life.
Thanks, Oliver. I'm going to start by taking you through our approach to portfolio construction. And we believe this is a real differentiator compared to our peer listed private equity vehicles. Most of our peers, they're either characterized as being direct investments. They tend to have high single company concentration. They often have a high exposure to a single sector or a single geography. Another peers operate a fund-to-fund strategy. So they've got underlying exposure to literally thousands of companies. And they tend to operate as a kind of an index on the broader private equity industry. We apply both sort of elements of both approaches in our portfolio construction. Firstly, around half of our portfolio is deployed through third-party funds. Now, Oliver's already outlined a very selective approach, and that's we're focused only on buyouts, only in developed markets, and we only partner with top-tier managers. Whereas many of our peers invest in ancillary strategies, so things like venture capital or growth equity. We strongly believe that mature buyout investments offer the best risk-adjusted returns. And the other half of our portfolio is in what we term high conviction investments. And that's through secondaries, co-investments, and investments alongside ICG, our manager. Now, the unifying theme here is that ICG selects and performs due diligence on the underlying companies. And what this does is it gives us control over the composition of our portfolio, but it also critically enhances returns. And you can see here from this diagram that the high conviction investments have generated returns of 25% in local currency over the last 5 years. It's annualized returns. However, we tend to focus on the blended return, which you can see here, 21%, as these third-party investments are fundamental in order to be able to access co-investments, if you like, as Oliver termed it, the greatest hits, alongside the world's leading buyout managers, which shows you our largest exposures. Now, the approach to portfolio construction, which I just outlined, means that our top 10 companies are a little under 30% of our portfolio. And that means that their performance makes a meaningful impact on our NAV growth, but without taking excessive single company risk. Now, we'll be very happy to take questions on any of these companies or indeed any of the other companies in our portfolio afterwards. But I'd just like to draw out a few themes. As Oliver outlined earlier, we're very focused on the concept of defensive growth. So identifying companies which have underlying growth drivers which outweigh any cyclical fluctuations. And in each case here, each of these companies, there's a very strong secular trend or trends which underlie each investment thesis. Another feature of our portfolio is the involvement of ICG. So 4 out of our top 10 companies are managed by ICG. And our larger exposures come from ICG's Europe strategy. Now, interestingly, that's been a cornerstone of our portfolio for most of our 40-year history. So our first investment in an ICG Europe fund happened way before we were managed by ICG back in 1989. Since 2016, when we joined ICG, we've been, being part of the platform has given us access to very strong deal flow. And it's very aligned with our defensive growth focus. One thing which is worth pointing out is that many of the companies in our portfolio have actually found, it's been obviously a relatively challenging environment, but many of our companies have found recent market conditions actually very favorable. For example, cloud software businesses like Visma, our 4th largest investment, saw growth actually accelerate through the pandemic as companies adapted to remote working. Leaf Home Solutions, US-based home improvements company, benefited from a significant increase in demand for home improvement services. For the very obvious reason that most people were spending more time in their homes. And Berlin Packaging, a company which focuses on the design and supply of packaging primarily for end markets in food and healthcare, benefited from strong underlying growth in those end markets as consumption patterns shifted away from restaurants and more towards consumption of food and healthcare products at home. One of the aims of our defensive growth focus is a desire, and you see this in the underlying performance of these companies, is a desire to achieve consistent returns. And we're just going to spend a little bit of time over the next few slides showing how that's reflected in our performance data. And you can see here on slide 11, our portfolio returns over the last 12 years. And you can see a very consistent track record of double-digit growth on a local currency basis. Since we joined ICG, and the first ICG year is FY17, we've generated annual portfolio growth of at least 15%. And in the last full financial year, despite the impact of the COVID pandemic, the portfolio had one of its strongest ever years with 25% growth, which we think is a real testament to the strength and resilience of our strategy. I think here the main thing is just to pick up on the consistency I was outlining. You can see here there have only been 2 quarters over the last 5 years where we've had contractions, and one of them was during the COVID pandemic. I think this reiterates that sort of the very consistent, steady returns we've been generating. Very briefly too on the dividend, you can see that since we adopted a progressive dividend policy moving to ICG, the dividend has steadily increased, and the board is aiming to pay a full year dividend of 27 pence per share, assuming there aren't any unforeseen circumstances for the current financial year. And that's a significant increase over last year's level of 24 pence. Just to touch on this very briefly, it's a recurring trend in our portfolio. And you should probably think of this whilst you're thinking about the underlying discounts as well. There's a long, sustained track record of realizations being at a significant uplift to carrying value. You can see those numbers on the chart. And we think that represents substantial hidden value within the portfolio, particularly given the consistency of that pattern. And very briefly, I suppose the key messages we'd like you to take away, and apologies if there's a little bit of repetition, we're a very experienced, long-term oriented investor. We have a proud 40-year heritage, which makes us the oldest listed private equity vehicle in the UK. We have a very clear purpose to democratize private equity, to allow private investors to benefit from the strength of the asset class, and we've got a very strong track record of delivering performance. And finally, one of our core differentiating features is that as part of the ICG platform, we benefit from the resources and experience of ICG plc, a large FTSE 100 company which exclusively focuses on private assets and has just under 70 billion euros of assets under management. And that's been a very significant factor in the progress we've made managing the vehicle over the last 5 years. So apologies for the quick canter towards the end, but I think myself and Oliver will be very happy now to take any questions that you might have.
So there are a number of questions. One of the questions is, obviously what you're doing is investing in a number of companies that have defensive growth strategies, but it can happen that things do not go right. And COVID could be an example of companies that a couple of years ago were priced for success. They're now priced mainly for survival. What strategy or what can you do in those sort of situations to minimize the risk? Because as you say, they're long-term investments and they are illiquid. And there must be an approach that you have when something doesn't go quite right that you can adopt.
Yeah, so our strategy and our investment strategy is very much driven by diversification, making sure that if we do have a problem, it doesn't hurt us. So as you look at the returns, in the darkest hour of COVID, we were only down 4%, which is significantly different to what happened in the public markets. If something does go wrong, we have, because we're long-term investors and private equity has a lot of resources, that's why we invest in funds and management teams who have the resources to kind of really fix the problems. And we have the capital as well as in private equity, you got the capital as well as the time to kind of fix the problems. To give you a sense of where we are in our portfolio. So if you take the top 30 in our portfolio, which represent about 50% of the total portfolio NAV, all of those companies are performing, and we don't have any concern or or a company which is losing its value.
Okay, thank you. What makes secondary transactions attractive, and will there be more of these to come?
Secondaries are incredibly attractive because you're buying effectively a portfolio which is 4 to 5 year, or let's say 4 to 6 years in maturity. And when you have those portfolios which are 4 to 6 years in maturity, you can pick you can see the winners and you can see the losers, and the losers typically in that portfolio have been already written down. And so therefore you're getting private equity type of returns because you can price the portfolio yourself, as well as you are getting high diversification. So you're getting much lower risk. Loss ratios in secondaries are typically less than 3%. And you get much higher liquidity because typically in the portfolio, because it's 4 to 6 years old, it's also 4 to 6 years closer to exit and realization. So typically you have on a quarterly basis distributions coming through. So it's a very attractive investment strategy as part of the portfolio. And because we have a large portfolio, we have insight with the managers, we can pick those particularly attractive secondaries. And the future of the secondaries market will continue to grow very much. It's been growing 15 to 20% CAGR over the past 20 years. And it will have another record year in 2021. We're expecting that the overall secondary market will double in the next 4 to 5 years.
Thank you. So we've got a question or a number of questions about the general trends in the PE market and how you handle the changes in valuation, but also how many situations are you looking at any one time that will lead you to a limited number of investments that you actually make, but you must be looking at a very, very large number. How do you filter those down to the manageable shortlist?
Yeah, so it's absolutely true to say that at any given moment in time, we have quite a significant sort of pipeline. But one of the things that I think, given our expertise and market knowledge, is we've adopted quite a rigorous process to filter those opportunities. I suppose thinking about it just in terms of our fund selection, that tends to have less volatility. We're always keeping abreast of we're exclusively investing with experienced managers. So we're tracking managers over time. It takes a long time for a manager to get into our portfolio. So there are sort of fewer surprises there. And that's really an effort of constant market mapping, constantly staying up to date with developments in the funds market. But we typically won't invest with the manager until we've really got to know them. So that's a much more gradual process. When it comes to the direct deals, we're particularly busy.
Just to give you an idea, we're invested about 20 to 30 fund managers out of a total universe in the US and Europe of about 2,500 to 3,000 managers.
Yeah, and we're targeting managers that have, we really value managers that have got strong institutional experience. Actually, that was something we really saw during the COVID pandemic, to answer one of the earlier questions as well. When things were going wrong, actually investing alongside experienced managers has particular value because they know what to do. They've been through crises before. In most cases, most of our managers have managed through the GFC. So they were very experienced at crisis management, and they have the resources to be able to deal with those situations. On the direct side, it's a very busy market at the moment. And just to put into context the kind of filter that we have, over the last year, we've had over 40 what we would consider actionable investment opportunities. And we've executed on 5 of them year to date. So that just gives you a sense of how selective the approach is. How do we do that? We have a sort of a multi-layered filtering system. So at the beginning, we identify if there's any particular attributes of deals that are no-nos for us. So we look at features that increase the risk. Oftentimes it's things that the company itself can do nothing about. So market-driven factors like being price takers, having significant customer concentration. So we have a sort of a rigorous kind of filtering checklist where we try to identify those things early on. And as we proceed through diligence, we get ever more detailed. We conduct a very extensive process. But one of the key features I think that we have that a lot of our peers don't is that we have very strong market intelligence, which comes from ICG. So we have so many other strategies within the group that are often experts in particular industries, and we can tap into that knowledge. And because we're part of ICG, we're getting very candid references and very sort of thorough very detailed access to very proprietary information. So hopefully that gives you a sense of the kind of process we go through.
So the final question is, when you have a successful investment, how do you ensure that basically adequate funding is available to allow that investment to continue to be successful?
Yeah, so the important thing is that you always have significant cash and liquidity available. We have a large facility in place of over £200 million, which and we have about 70 million in cash right now. So we always make sure that we have enough reserves in place, even if we have our full cash and invested. We still have about £200 million we can draw on in terms of reserves. So we have plenty of firepower to kind of make sure that we can follow the growth of winners.
Gentlemen, thank you very, very much.
The next company we're going to hear from is DWF Group. The legal services space is a very interesting one for investors because the UK is a global leader in it, but it's quite difficult to invest in because most of the legal practices are partnerships, and anybody outside the partnership doesn't get the chance to share in those kind of returns. We've had a number of law firms listed in the last few years, however, amongst which is DWF. What's different about DWF is that it's a global firm. It's got 4,000 staff in something like 30 locations across the world. There are three parts to its business. The bit we'll all think of, which is legal advisory, but then they've got a business called Mindcrest, which provides outsourced and standardized alternative legal workflows and connected services, which is business services complementing the legal offering. You'll see up on your screen a little slide, shows you who the shareholders are. Pretty good set of names there. Decent dividend yield on this. But I think the chart below is interesting because it's got 4 lawyers on there. They all, the share prices of all of them took a bit of a bath when the pandemic hit, and they've recovered pretty well from that. The one that's still below that level of January is DWF, which you might well argue provides the biggest opportunity for investors. Today, we're very lucky to have the Group Cfo of DWF, Chris Stefani, to address us. Chris, over to you.
Thank you very much for that introduction, Keith, and good afternoon to everybody. Great to be talking to you. I am Chris Stefani. I'm the Chief Financial Officer of DWF Group. Very brief background about me. I spent 17 years at EY, always an accountant for the accountants, so I was back office finance, and then I've spent the last almost 6 years at DWF. So I've got about 23 years in the professional services sector, focusing on performance improvement and business optimization. Fun fact, I started life as a law graduate, but thought it was too dull, so became an accountant instead. So you can take from that what you will about me, but I've ended up at DWF, which when I joined was a privately owned law firm, but 2.5 years ago, in February 19, listed on the main market of the London Stock Exchange. This is a bit of a summary of who we are, albeit Keith has touched upon some of these points. So we are a full service law firm, but we call ourselves a legal business, and that's quite deliberate. And it might sound like lawyerly semantics, but the fact that we're not just a law firm, we also have Mindcrest, which is an alternative legal services provider, and we have Connected Services, which provides adjacent services to law that we know that many of our clients need. Our strategy is centered around integrating those services and selling what we call integrated legal management to our clients. We're the only main market listed legal business. We felt the main market was appropriate for our scale. And there's a small cohort of other listed legals, 6 in total on AIM. We hope and expect there to be more coming to market, and we would welcome that because currently we are an asset class that I think is not fully understood. The statistics you see on this page, I won't read them back to you, but you can see the geographical reach. We've got 30 global locations. We operate in 8 sectors, and our scale to April 21 was 338 million. In terms of the market that we operate in, The characteristics are outlined here. There's a lot of words on here, but I'll give you just the 6 sound bites, and that is we are in a growing market, 750 billion globally, growing at a rate of circa 5%. The other things that are going on in the market, ALSP is accelerating. So that part of the market, those are alternative legal service providers bringing technology and process into the mix, challenging really the traditional model, growing at 15% per year. Now, we bought Mindcrest, which is an ALSP. We're one of the very few firms that we're aware of that have that sort of offering. Clients are rationalizing their supply chain, so the work is being shared out amongst fewer firms. So those with a global reach serving global clients will tend to fare well in that environment. There's huge fragmentation still, though, and I think the supply chain consolidation is going to drive consolidation, and we welcome that. We believe M&A is going to be an important part of our strategy, and it has been in the past. ESG is rising up the agenda, so increasingly you have to have credentials in that space and ensure that you're operating for more than just profit. And then, the listing point is an important one. There are 7 firms currently listed, of which we are one. We believe that places us very well to be able to execute M&A and to take advantage of the growth opportunities in the market. And we think there will be others coming to the market, but to some extent, we invested early in the asset that is being listed, and we intend to leverage that. Brief history. Keith showed the share price graph, and if you were to overlay that on this, you would sort of see the turbulence that we've had. We started out when we acquired Mindcrest back in February 20, just prior to COVID. We were about just over £1.40 share price. COVID impacted. We had to do 2 market updates as a result because it impacted in the final quarter of our year, just when we had deployed some debt off the balance sheet for 2 acquisitions, one of which was Mindcrest. The end result of all that turbulence was a change in CEO and the appointment of a COO and a 100-day plan to really get the business back on track and focused. And over the course of the year, you can see a lot happen, but the highlights were, well, firstly, the appointment of Sir Nigel Knowles as our CEO. He built one of the largest law firms in the world, DLA. So his pedigree in the legal space is really a force to be reckoned with. We took actions around loss-making and misaligned operations and took a lot of negative EBITDA drag out of the mix. We invested further in capacity in Mindcrest in Pune, which gives us a margin labour arbitrage opportunity, and we also effected a new operating structure which really supports the strategy that we're executing. And that strategy is very simple. We've got 3 offerings: the legal advisory or traditional law, Mindcrest, which is the LSP, connected services, which are adjacent but needed by our clients, and that really encourages the supply chain consolidation angle. The divisions here are laid out in numbers. And you can see legal advisory is the largest with the highest margin, what you would expect really in sort of traditional legal services. Over time, we expect the Mindcrest and Connected to grow at a faster pace, and also for the margins to expand in both of those businesses as they mature from investment phase. But the whole point is we want to broaden the share of wallet with our clients, and the trends that I talked about in the sector are for that supply chain consolidation. So we feel we're well placed. This is just an example of integrated legal management in action. So we've got our claims management offering in connected services, referring 5.9 million of work in FY21 into legal advisory. We expect that to rise to 8 million in FY22, the year we're currently trading in. Now, that will make connected services the 3rd largest client for our insurance practice area, which just goes to show that kind of client sharing opportunity that our strategy is looking to leverage. And then no presentation about our business would be complete without talking about being a responsible business. Again, I won't read all the characteristics here, but we are committing to science-based targets, and we're going to release our ESG strategy along with our results on the 9th of December. We've got the DWF Foundation, through which we donate to charities and good causes, and we have what we believe are quite bold targets around diversity, particularly in senior leadership and in workforce representation. Then on to the financials. So these are the financials to April 21. So slightly out of date in that we're about to issue our half-year results to October, which we'll release on the 9th of December. But you can see here net revenue to April 21 grew by 14%. That included an M&A impact, but also 8% organic growth. We expanded revenue per partner, which is a productivity metric, which is a bellwether for gross margin, which you can see as a third point on that slide. And that we expanded margin by almost 3 percentage points. We then took 2.2 percentage points out of our cost to income ratio, which is just overheads as a percentage of revenue. And that all drove the adjusted PBT to more than double. Now, that was from a low base point, which was heavily COVID affected. And we're very pleased with 125% improvement, as you can imagine. But that's still only a 10% margin on revenue. If you look at the other listed legals, they range between 12 and 18. And we believe there's no structural reason why we shouldn't be trading in a similar range eventually. And our guidance points towards that. EPS followed PBT in terms of trend, and attached to that was a 4.5p full year dividend per share. Dividend's important to us because the partners are significant shareholders, and that is essentially part of their income. The final two dynamics here are around the balance sheet. So lockup is a metric, I think, unique to professional services and especially law. It's a measure of working capital efficiency. Taking 20 days out of the cycle is a good thing. That is worth just over $1 million in cash per day. Now, we didn't see a consequent reduction in net debt. We reduced it by $5 million. That's because we are paying down deferred consideration for the acquisitions I mentioned earlier. So we currently have a higher level of leverage than we would normally trade on. I'll talk about where we end up on that very shortly. Very quickly then, the 2-year trend is illustrated in the graphs that follow. The bar charts are absolute numbers in half-year increments, and the red lines are percentage on the right-hand axis. And you can see revenue growth has consistently been in the close to double-digit range, strong organic, supplemented by M&A, and the growth continued in FY21 despite us discontinuing and slimming down a number of loss-making operations. You can see the COVID impact here. So gross margin over the same time period dipped in FY20 H2 and then bounced back and then improved as we executed some operational changes to drive efficiency, and then cost to income ratio, a steady downward drift. All of that driving an even more impact, a greater impact on PBT because of the operating leverage in the business, which dipped considerably in FY20 H2. But then you can see the bounce back and you can see the trajectory getting into 12% range in the second half of FY21. So that plays to the sort of trajectory I mentioned earlier, and EPS and DPS following suit. Lockup days, which is working capital efficiency and cash generation, stretched by COVID to 206, and then 10 days out of the cycle in each of the two following half years. And then you can see free cash flow negative in FY20 H1, slightly positive in H2, and then significant cash generation as we got some efficiency and discipline into the business following the appointment of Sir Nigel and Matt Doughty as COO. And you can see net debt relatively flat, but leverage, if we were to show that on a graph, on a steady downward drift. Talking of capital management, so dividends important to us. Target payout ratio of up to 70% of adjusted profit after tax. Interim in February, March time, final October. Borrowings and leverage target to be between half a turn and 1 times pre-IFRS 16 EBITDA. M&A very much back onto the agenda now that we are trading strongly, albeit we would be circumspect about how much cash would come in off the balance sheet. We intend to use our listed status to make sure we can effect strategic M&A. And CapEx, relatively capital-light business. Where we invest is around IT, as you might expect, particularly infrastructure and cybersecurity. And we'll also invest in buildings because what we have proven over the last 18 months is that we do not need the level of space we currently have. We've all proved that. We spend 25 million on properties. Our staff tell us they want to come in maximum of 50% of the time. Now, we won't lose 50% of that cost, but we're certainly attacking it with the intention of bringing some efficiency into the mix. We reinstated guidance when we came out with our full year results in July. We are predicting medium-term revenue growth CAGR between 6 and 7%, margins expanding to between 53 and 54 at the gross margin level, and cost-to-income ratio of 38%. That all plays through to a pre-BT margin that gets into the teens, and then lock-up days we intend to drive down further, and that's going to have a knock-on on leverage. Base case guidance only. If M&A happens, it will be incremental to this. So broadly, what we've achieved in FY21, and what we will talk more about when we come out in December, is that we've been growing strongly. We've been doing that but also it's profitable growth. We've been driving margin efficiency, and that's dropped through to the PBT. And at the same time, we're driving balance sheet health and aiming to reduce net debt and leverage over time. And EPS has increased significantly, and we paid the largest dividend we've ever paid at 4.5p. Bear in mind, we're 2.5 years listed, so we don't have a long history, albeit we've been in existence for more than 40 years, not as a listed entity. So why invest? Well, we think we've got a differentiated model. We're a global business. The revenue attributes include some predictable recurring alongside transactional. We've got an opportunity in the market to do opportunistic M&A. We're experts in what we do. We're a diverse team, and we've got very experienced management, both in professional services and in the legal sector, to drive continued progress within the business. And we aim to be the leading global provider of integrated legal and business services in a market that is growing and has huge opportunities. That's everything I wanted to say, and I'm really happy to take questions now.
You see, you've transitioned from basically being a private, very ambitious, traditional law firm into a listed business with very significant international aspirations. Has there been a significant change in the internal culture of the business in order to be able to meet this? And you could maybe address this from two issues. One is, have you lost certain key people? But also, has it meant that in terms of hiring teams of people, they've found coming to DWF more attractive than they possibly would have done in the past?
Okay, great. Really interesting question. So DWF has for quite a long time really been quite corporate in its approach. So had a CEO rather than a managing partner or CEO and managing partner for many years. Remuneration committees, very few issues that were voted on by the partnership. So DWF had come a long way down the kind of corporatized model before listing. So it wasn't so much of a shock to the system, and we had a decent run-in of a time period to educate the partnership in what it means to be not privately owned anymore and to be reporting to the market. And I think we've turbocharged that over the last 18 months in particular, given the very real impact of COVID and how much focus that put on governance and so on in a listed model. So we've come a long way, but these things are evolution, not revolution. And I think with, frankly, every month that passes, we are more corporate and PLC in our approach than we've ever been. From a point of view of hiring, we've lost very few people from the point of view of senior partners and so on. I think the people that didn't want to be part of a listed business, got off the bus before the listing happened. We've got very low regretted attrition, and we are attracting people who believe in two things. One, the differentiated model and the fact that we're doing something different to being just a law firm, and two, the fact that we're listed. And that has a number of different things. It gives us opportunities to invest and access to capital that others don't have. It also allows us to reward in a more innovative way. And most important of all, from the reward perspective, you put partners' capital into a private firm, and when you leave, you take your capital out and you get the same amount. We have the opportunity for capital upside as well as income in the remuneration model that we offer.
Okay, I've got a very specific question here from Martin, and then I want to go back and just talk about acquisitions and the value of the DWF brand. So Martin says there are similar legal companies listed on the AIM market, which is what Keith said at the beginning. And these trade at a higher multiple to DWF. This may be due to inheritance tax advantages of the AIM market. So we're talking about business relief and the IHT funds that are able to buy in this market, and obviously for private investors as well. Would DWF consider a move to the AIM market to boost the share price? Another way of saying this is, what are the benefits of being on the main market as opposed to on AIM for you?
I think we don't or haven't had the view that not being on AIM and not having the IHT advantages has constrained our share price. I think, frankly, in life, timing is everything. And we came into the market in Q1 of 2019, which is one of the leanest periods for IPOs. So it was a difficult listing. We then were just beginning to get momentum, and Mindcrest began, and the acquisition there got us to a peak share price of, I think, £1.44. And there was real momentum there. And then COVID hit, and it was the perfect storm for us because it hit in the crucial final quarter of our year, when we had fairly punchy targets that we were expecting to meet. So a lot of the lost revenue dropped through in that final quarter. Plus, we were more highly leveraged than we would normally have been expected to because cash collection slowed. So all of those things led to two, essentially profit warnings. And if you look at the share price graph, you'll see that it bottomed out at about 50p. So we listed at £1.22. We trading today, I think we opened at 108. So we've clawed a lot of the lost ground back. I think there's a degree of demonstrating a track record, which we're now doing. And I think that is the thing that will drive share price appreciation. But you're quite right. The multiple is low. It's not just us saying it. We don't really like commenting on our own share price because we just want to run the business and the share price ought to take care of itself. But if you look at the analyst research, the target price is well above where we're currently trading, and they all comment on the fact that the multiple looks anomalous.
So I'm going to try to combine this two questions into one. So when you're looking to buy other firms, are you looking to buy the brand name, the people? What is it you're trying to buy, and how do you value whatever that asset is? And the second question is, why would firms want to sell to DWF as opposed to anyone else? What is it that you offer that other firms possibly don't offer?
Okay, there's a few different dynamics in there. So we acquire where we want to either be in a new geography, a new specialism, or if we want to expand the capacity that we've got in areas that are hot. We only acquire where we are very confident that there's cultural alignment because, fundamentally we're a people business. So you just can't acquire for acquisition's sake, and it's got to be strategically aligned. What we value is, one, access to either new market or new offering. And we value the expertise that we are acquiring and the track record of profitable growth. Frankly, client overlap's important. And we structure deals in a number of different ways. We don't always pay a multiple. We have done NAV deals. Why do people come to us? Well, or want to be acquired by us? Partly, I think the growing strength of the brand. I think that plays to the main market point you asked about earlier. We've probably got a degree of prominence from that. I think the integrated legal management offering and the fact that people recognise that resonates with clients. And frankly, being listed, we have the ability to structure deals in a way that private law firms would not. And therefore, you probably see more traditional merger activity in the private space, whereas in the listed space, we can do things in a little more of an innovative way.
So the last question is basically due to something is related to something you mentioned, which was the impact of COVID on the business model. So I think even before COVID, people were having issues in trying to value law firms because it simply is a relatively new sector to the market for the general investor. Then we've had COVID, and COVID has obviously made a number of changes, or you've referred to a number of changes. How easy will it be for you to, I would say, transmit the new working model for the post-COVID period, given the fact you've said there will be far less emphasis on space, etc., etc. And what should investors really be looking at as the 2 or 3 key metrics in order to measure your business against other businesses in the sector going forward? So it's to try to help investors understand what's happening, which is exactly what we've got this session about today.
Yeah. So I think demonstrating profitable growth is point number 1 for me. Growth for growth's sake is not going to get anybody anywhere. It's got to be profitable growth. We've come from a sort of unique place from the point of view of where we were profitability-wise when we listed, and then what happened post-COVID. So I think demonstrating profitable growth and frankly just delivering on our guidance and extending the track record of performance is going to be crucial. We're coming from a space where we deployed quite a lot of capital on 2 acquisitions, which we're very happy we made because they're performing very well. As those kick off cash, we will deleverage, and leverage is a sensitive point in this sector. We are at the higher end compared to the other listed legals, and as we continue to demonstrate self-help through lockup reduction and reduced leverage through cash generation and profit improvement, then that combined with a growing PBT margin is really what I would point people towards. Profitable growth, balance sheet health. I would hope that will be recognised from the point of view of value.
Chris, that's absolutely fantastic. It's been great chatting to you.
Okay, so our next presentation comes from Fulham Shore. Fulham Shore is a business that you may not know it as such, but you will know its 2 restaurant brands, Franco Manca and Real Greek. The team behind Fulham Shore's had a very successful track record in the restaurant trade. And I think both of these propositions are slightly unique. You've got up there the charts that shows it's got a good following in terms of shareholders. The share price chart, obviously, like everything else in the hospitality sector, took a real bath as the pandemic hit, but has now recovered substantially beyond where it was at the time that the pandemic hit in terms of share price. But I think probably David's going to tell us that the pandemic's opened up some tremendous opportunity for them in terms of being able to grow the business and the number of sites. David, over to you and Nick. David Page is the chairman. I should have introduced him. Nick Wong is the finance director of Fulham Shore. Gents, over to you.
So this is Fulham Shore, which is an AIM market company. And we currently have about 76 restaurants, and we're opening restaurants quite quickly at the moment, and we'll increase that opening program over the next year or 2. So we founded this company in 2012, floated it a few years later, and our object was to look for scalable businesses that were really good value for the customer and had great food. Nick, who will come along later in this presentation, is a relative new person to the team, and he's been with us 15 years. But I've been involved in restaurants for 45 years in the UK, and a lot of this team with me built up Pizza Express, and then they built up Gourmet Burger Kitchen, and we sold them each time. Currently, we're capitalised at about £110 million. But the point of this presentation is to hopefully explain we're just about to take off in terms of expansion, because we have survived and then we're now back into a profitable mode after the coronavirus pandemic. So as I say, we were looking around for 2 or 3 businesses that we were going to put into this company. And we bought Franco Manca when it was 11 strong, and we're now 56. We bought the Greek when it was 6, now 20. And as I say, both businesses are about to accelerate their opening program for reasons we'll come on to later. Our idea is, or was and is, to make a success of these restaurant businesses and then replicate them throughout the UK and now abroad. We try and avoid a chain mentality that infects a lot of businesses when they get to scale. For instance, we avoid this by each restaurant has their own profit share scheme, and they effectively compete with other restaurants in the group. So we're adding shareholder value by incentivizing our staff and keeping our prices low. We test our prices against our competitors every month, and we intend to keep our prices at least 20% below our competitors, and therefore not only this drives customer volume through the customer numbers through the restaurants, but they come in because the food's better than our competitors, or we like to think so anyway. So as you can see on the graph on the right, we slowed down a little during COVID, and we're now accelerating again. But of course, we'll come on to in a minute what happened. But we were throwing off cash. This is a business that throws off cash the whole time, even during COVID. So we will explain later that we have eliminated all debt. And when we switched during COVID to delivery only, although our Greek business lost money, our Franco-Manca businesses, some of them were twice as busy as they normally were, with much less staff. And so we made quite a lot of profits during COVID through switching to delivery. We wanted businesses that had a low price point for the customer, that were cash generative. For instance, the return on capital we look for when we open a restaurant, both businesses, is over 30% payback. So our payback is 3 years. And each business is trading extremely strongly at the moment. We think in the UK, we are Franco-Manca, which is at about £12 a head for the customer and £10 for us after VAT normalised VAT is taken off. We think at that price point we could probably have 200 in the UK, and we've currently just got just over 50. And we think the Real Greek, which is currently 20, could probably go to 50. So there's a lot of room for a rollout in the UK, let alone abroad. We have all been together for many years. We have been involved in other businesses. We know how restaurants work. The board, have around a short 40% of the listed company. So our wealth and shareholders' wealth are aligned. And Mr. Wong will come on to later the finances of the company over the last year or two and currently. We are now in a very good position with cash in the bank and very profitable. So we did have plans for a dividend policy before COVID, which we shelved, but we're now re-examining that, and we intend to look at it very carefully in a very short space of time. Just on that, our half-year figures come out week beginning the 6th of December, so in a few weeks' time. And the bottom point there is that historically, this sector has been very attractive to private equity and VC because they understand a rollout program. Restaurants are a very easy business to understand because you take the cash in and you pay the suppliers a few weeks later. You can immediately test the return on capital from the volumes the restaurant are doing, and you can see the margin in the business on a weekly, if not daily basis. So it's a very easy business to analyze and understand and to invest in the successful ones.
Right. Hello, everyone. So Franco-Manca is an award-winning Neapolitan sourdough pizza business. We make all our sourdough pizzas in-house. All the dough is made fresh every day by our pizzaiolo. We now have 56 Franco-Mancas across the UK. We had actually 53 at our last year end in March 2021. And our long-term ambition is to grow this business to over 180 Franco-Manca pizzerias in the UK. Fulham Shore has grown this business from acquisition at 11 restaurants to now 56 in these 6 years. And Franco-Manca has been very well received by our customers, and we've won countless rewards. We won a recent one that's not in the slides just yesterday from the Peach Awards. We're growing the customer base with the new openings, and we get lots of favorable reviews. And now we serve over 100,000 pizzas a week. And even very simple things like dips that accompany our pizzas, we're selling £1 million worth now a year. Our London suburbs and the regional pizzerias have been trading especially well since the lockdown ended, particularly because commuters have been working from home, and the whole dynamics have really changed since March 2020. We do now have one pizzeria in build, which is in Baker Street, and that's due to open in a couple of weeks' time. And we have plans to franchise internationally. And in fact, we mentioned that we signed a new deal with a company, a very seasoned operator in Greece, to open 6 new restaurants. And we'll come a little bit more onto franchising in a few slides' time. One thing to really sort of mention is that we've really embraced technology in Frank & Manca, and we've built a loyalty app, and which we launched only a few months before the pandemic hit. And we've now grown the user base to over 250,000 customers, up from 110,000 pre-pandemic. And this mechanic is very simple. It allows the customers to earn stamps for the visits that, whether it's dine-in or delivery or takeaway, they can earn a stamp for dining with us. Our website traffic has also increased 20% over the last couple of years. We have a lot of new revenue streams as well, including the pizza kits, gift cards, merchandising. We've also embraced a new technology, virtual queue, which we are using in Scotland at the moment. And obviously our openings are driving a lot of the web traffic. I've mentioned about the virtual queue just now. It's encouraged a lot of customers to join without having to make bookings, and it helps manage the queue outside the front door. All of this feeds into a single customer view, which gives us a very good insight into what our customers are doing, what they need, what they enjoy most about their experiences, and it allows us to personalize promotions and, of course, in the long run, target and reactivate lapsed customers.
Okay. Our second business is The Real Greek, which now has 20 restaurants. The Real Greek costs a little bit more to build than a Frank & Manca, but still has the same rate of return, payback in 3 years. So over a 30% return on capital we're aiming for. It's very popular with the public. It's slightly busier per store than Frank & Manca. They're bigger, and they're in shopping centres where there's a higher footfall. And our ambition is to get up to 50. We're just about to open 2 in new Real Greeks in Kent and Manchester, at Blue Water and the Corn Exchange, that will open before Christmas. And we're building a pipeline around the UK. Very busy, very popular restaurants, and we launched a grocery shop as well in February 21. The Greek was not set up for delivery when COVID struck, so actually lost a little bit of money during the COVID period when we were having to close. But Frank & Manca made up for it, and that's why we come to the cash generation that Nick will talk about in a minute. In both our businesses, on the next page, we've got some fantastic staff who've been with us quite a long time and have moved with us from the various businesses that we've owned, where they have short and long-term incentive schemes. Half our staff have shares in the business, we believe, as a result of a gifting mechanism when we floated. And we're always looking to incentivize staff, particularly over the last few months, where we actually, because our sales are so strong, we put out various announcements to say our group sales were running 20-30% ahead of 2019. And this has enabled us to put up wages quite a lot. And this has reduced our vacancies. So we are now the highest paying people in the sector, we think. And that means that our competitors are getting very cross with us because we're paying our chefs a lot more.
Yes, these are quite historic now. And as David mentioned, our half-year results are coming out at the beginning of December. So a key measure in terms of our financials in the year is that our net debt number has significantly improved we started off the financial year with £9.5 million worth of net debt, and we reduced that down to 3.6, despite us going through the pandemic. We started the year in lockdown at the beginning of April, and we had just 43% trading time during that financial year without restrictions. So it was a very different year than normal. We did, however, manage to open 2 Frank & Manker's Pizzeria in that time, and 1 Real Greek restaurant as well. Just to cover off some of the numbers, obviously revenue was down as a result of the closures and the restrictions on dine-in trade. However, it was a very varied year, with the first quarter being closed, the fourth quarter in full lockdown, and quarter 2 and 3 we were trading very well with both dine-in and delivery and takeaway. Since the year end, we've opened 3 more Frank & Mankers and 1 Real Greek in Norwich. We are now in a sort of net cash position. I'll take you through our banking and cash position on the next slide. Our funding at the moment, a couple of weeks ago, we renegotiated with our bank, HSBC, and we repaid our Cfo loan, which we took out during the height of the pandemic. So our banking facilities now is 17.75 million, which is made up of a new RCF facility, a 3-year term, and an overdraft facility of 0.75. By refinancing, we have removed all restrictions that previously existed with our Cfo loan, which allows us now to really focus on our opening and growth programs in the coming years. Our covenants, again, very historic now. We had covenant waivers in place up till September 2021, but in fact, from June onwards, we've been passing all our covenants, all our covenant tests, and hence the refinancing. Our net debt, as I mentioned, has really swung from the £9.4 million to a positive 5 million today. And of course, that really shows the cash generation of the 2 businesses. And as David mentioned, it's very cash generative running these restaurants. And when we're not opening, these cash accumulate over time.
Our property costs are falling in new stores. Landlord contributions are now being made to us. We've opened 1 Real Greek restaurant for nothing, which is an old Carluccio's. It cost us £200,000 to renovate from Carluccio's, but the landlord gave us all the money. And so we've opened it for nothing, and it's taking over £30,000 a week, and will probably contribute nigh on £400,000 or £500,000. Quite an amazing return on no capital. The average capital cost, as I mentioned before, is about £650 for a Frank & Manker and £750 for a Real Greek. Once again, as I said before, we're targeting a 3-year payback, and that's what happens on average. That can be boosted, as I say, by landlord contributions. And as Nick has said, we have now got a bank arrangement in place, which means with the cash we've got in the bank, we've actually got a £20 million headroom, which is enough to actually grow by 30 or 35 stores a year, which we're not going to for a couple of years. International franchising on page 13, we've signed in Greece. We're going to open in a couple of other territories abroad. The real big ones we're going for will be Germany, France, and Spain, and Japan, sort of countries that have a proper property system and have opportunities for us to open 50 to 150 stores in each one. So those are our major plays in terms of franchising. Franchising won't contribute very much for the first year or 2, but it'll be a boost to profits going forward after that. Current trading, all the restaurants are reopened. They're very busy. London's centre restaurants and office locations took a bit of time to get going, but now they're in positive territory. Baker Street is being fitted out. That'll be 57 Frank & Mankers. We're just about to, as Nick and I said, bring out a half-year figures in early December. which we believe will be well received. And that's with only 10 weeks out of 26 trading properly. We've got lots of sites in solicitors' hands to push up the opening program. We're going to do around 10 new ones this financial year, maybe a bit more, and we'll probably try and double that in the next financial year. We've got net cash at the bank at the moment. We've repaid our clippable loan. We're well funded. We've got 2 great businesses that are very popular with the public, queues at peak times, and we're starting to go international. Nick and I have been involved in international franchising before at Conway Boat Kitchen and myself with Pizza Express. I've brought it in about 10 different territories abroad. So we're a well-funded company, and we're really enthusiastic and proud of the 2 businesses that we own. And there's a little map at the end to show everybody where we are. We're London-centric at the moment, but we are spreading all around the UK.
Right. Hello. Thank you very much indeed, David and Nick. So we're going to go on to a few questions. There seems to be a certain amount of concern in the audience that we're going to get another lockdown. Now, I don't know how this is playing into your planning, but either basically you say you've got a very strong direct delivery system that you've now tested and learnt about, or basically the bad news isn't as bad as some people think. You've got your restaurants open and you're paying more than the competition, so you've basically got no issues. Is that a fair summary of where you stand? But as a team, if you had to sort of hedge your bets a bit, what do you think the chances of another big lockdown or problem could be next year? Or are you basically very optimistic?
Cautious, like everybody else. Mr. Wong might want to answer, but I can't see them doing a full lockdown. It will be lockdown for people who haven't been vaccinated, like every other country is going towards. This is my view. But in lockdown, we were pretty astonished at how well our restaurants did. As I said, some of our restaurants were twice as busy than in normal trading, just doing delivery, but with only 3 or 4 staff. I'm not sure Boris and Rishi will go for a lockdown because they'll have to pay another lot of furlough. I'm not sure they're up for that. Nick, I mean...
Yeah, absolutely. And I agree with David. We've been trading very well through lockdowns. In fact, the only time that we were fully closed was the first couple of weeks of lockdown, and then we would have been able to do delivery and takeaway across most of the estates, and they were profitable. And the whole team is now for a season at dealing with whether local lockdowns or a countrywide lockdown. So we are ready if there is another one. As we've shown, we're still able to open new restaurants during the lockdown. And of course, with this business, because it's so cash generative, we can always slow down the openings to ride out any sort of temporary restrictions that the government may levy.
Okay, so another question is, obviously the restaurant sector has been hit very badly during COVID. How many walking dead are still standing in the restaurant sector that you think over the next 6 to 12 months may disappear? And that would then tie into another question, which is your expansion plans, certainly in the UK, are very ambitious before we even talk about the overseas ones. Are you absolutely convinced there are enough staff available to be able to staff these units as and when you open them?
When you're running an expansion program, you can't go hell for leather straight away. Our previous experience with Express was we accelerated. When we floated, I think we did 7 and then 14, 21, 28, 35 every year. And that's what we'll be doing here. We'll be doing 10 or more this year and then maybe 20 the next year and then more after that per year. We are paying the best in the sector, so our staff vacancies have gone down dramatically. We're pinching our staff from other people who are getting a little bit upset with us. But we are, because of our sales. I mean, we've put out that our group sales are 20 or 30% ahead of 2019. With those sort of sales, you can afford to pay people more. And your question was, how difficult is it for the opposition? I mean, it is very difficult. They can't get staff. They can't open the restaurants. They put notices up in in the window saying we're closed today because we can't open staff, or we don't open at lunchtime. We don't have that issue because we're paying the best in the sector. We pay under 25s the national living wage and above. So we are very popular. And as to capacity coming out of the sector, which you asked about, we think at least 20% capacity has come out of the sector, and the real crunch date for, I can't remember, did you say walking wounded, something like that, or living
Something
dead?
like that, yeah.
Walking wounded.
Dead.
Will be Nick will confirm it's March or April when all those government reliefs will sort of come off at once. There's a protection for the landlords that finish in March next year, April next year. There's the rates issue and things, and these walking wounded or whatever will fall over, or more of them will fall over in March 22, I think.
I've got a very specific question here about Greece from Stuart. The recent announcement that Frank & Manca will start a franchise in Greece is good news. However, as the directors have independently bought 10% of this franchise, do you agree that there could be conflicts of interest for board members being involved as both a franchisor and a franchisee? Would it not have been better for Fulham Shore to have bought these shares in the new franchise instead?
Well, as you can imagine, that was considered. The franchisee wanted an investment from the UK, but the board, franchising and investing in the equity are two very different things. I mean, I used to be the major franchisee of Peace Express, and we franchised in many countries around the world with different brands. JVs or minority investments is something I think we should avoid as a company, because the risk profile is just completely different. Saying that, I mean, and also the size of the country is quite important in the terms of the decision. If it was Japan or France or Germany or Spain, the company might consider a carry. But I mean, you're a minority partner, so it comes with a lot of risk. I mean, the best route is franchising. This Greek franchisee wanted some extra encouragement from the UK, and the board didn't really want to invest the board's money because it's too risky. So the halfway house was a couple of the directors investing. Nick, I mean, I think that's about it. I mean, we wouldn't not consider investing as a main company in a franchise abroad, but it would have to be pretty special to deviate from the franchise model. You can always put in the franchise agreement as an option to buy if the company wanted to get involved. But once again, it would have to be a big market for us to be really interested, to push the needle, if you see what I mean. It would have to be one of those big countries with 50, 60, 70 million people.
Okay, I've got several more questions. I'm not sure we're going to have time to go through them all. So very, very quickly, do you offer staff a training program? And is that critical to ensuring that you have a supply of adequately trained labour in the future?
Mr. Wong, yes, we do. Mr. Wong, yes. Over to you.
Yeah,
I'm hogging the limelight here.
We do have a training program, and in fact, since the summer, we have invested heavily in training because the skill sets of some of the staff members have changed over the lockdown. So we've invested in more training for all new joiners and also existing staff since returning to work. And it is critical that we continue to train our staff because the world is changing day by day, and our systems are changing day by day.
Right. Okay. Do you see any menu pricing upside in either Frank & Manca or the Real Greek over the next 12 months?
Yep. We got away with very marginal price increases over the last 2 years, maybe 4 or 5% over that period. Costs are still rising, but as I said earlier on, we are because of our very large volume increases, we are managing to mitigate that, and our margins are, I'm not sure what I could say, but our margins are they're not as under pressure as presumably other people's are, because we've got these fantastic volume increases in the two businesses. Our wages, we put up a lot. That's the main the pressure point. Food costs and property costs are either stable or marginally better for us, because as you grow, your food costs shouldn't really go up because your suppliers are getting more business from you, and so you can negotiate better prices or keeping the prices the same despite the currency fluctuations and their increased costs. But they know they're going to get more business from you. So when you're expanding a business, it's very helpful to negotiating food input costs. It's the wages that are the main cost increase.
Right, so I think we'll finish on the last question, which was, when I was younger, there seemed to be a lot of Greek restaurants in London, and people found that Greek food was incredibly popular, having gone on holiday. Is it not true that the market could support a larger base of the real Greek than the numbers you've mentioned in the presentation? I think it's 50 in due course.
I think we didn't predict 50 even a couple of years ago, but our new openings in Bracknell, Norwich, Bournemouth are absolutely flying. So we've said 50, but you're right, it could be some more. You said they were popular, but can I say that the food maybe wasn't as brilliant as it is now? If you go to Greece now, as I do, and we all our suppliers obviously are in Greece, and we go and visit them and go out to restaurants. The cuisine in Greece has just completely changed from 30 or 40 years ago. I mean, they've got some absolutely fantastic restaurants, and their cuisine is off the charts. So we, in fact, in the Greek this week, we've got a 2-star Michelin chef and a 1-star Michelin chef in our training kitchen, working with our chefs. So even within the very successful business like the Real Greek, we're trying to improve the quality of the food all the time. So you're right. Maybe we come to 30 or 40. We think that we might push the target up in terms of number of restaurants in the UK. But we're saying 50 for now to not disappoint people. Really.
Okay, I've just got one last quick question that's come in. As the company is basically focusing on two names at the moment, is it unlikely that you will introduce a third brand, i.e. a different food culture, into your business model?
Mr. Wong, I think we might add on. We have talked over the years of adding on maybe another pizza business, so we can benefit from buying, which any business that we buy might not be able to lock into that at the moment. But Mr. Wong, I mean, we're not looking specifically for a third business or anything. Mr. Wong, would you agree?
We're focusing on the two, but we will consider either site packages or potentially another pizza operator to bolt on if that comes across our table.
Okay, gentlemen, thank you very much indeed. It's been great chatting to you.
So our final speaker today is Hardman's own Nigel Hawkins. Nigel's an analyst specialising in the energy, utilities, infrastructure and renewables sectors. He's been involved in analysing the utilities sector since the 1980s, when he was part of the team that privatised the electricity and the water companies between 1989 and 95. He writes for the Utility Week magazine. He's also got quite a political background, which is important in this sector because a lot of what drives share prices is regulation. Between 1984 and 87, he was Margaret Thatcher's political correspondence secretary. He joined Hardman in February 2016, and he's going to give a presentation on the renewable sector. Nigel, over to you.
Thank you very much, Keith. And thank you very much to MJ Howard, who are hosting us here this afternoon. The key events in the sector over the last few years have been first the privatisation of the electricity supply industry in 1990 and 91. And in the intervening 30 years, we've seen some major structural changes You'll have seen also the events in Glasgow over the last couple of weeks at COP26 and the efforts to get rid of coal as a fuel. The rise and fall of gas is also particularly topical at present. In the 1990s, early 2000s, it was very much base load. It has now moved in many cases to mid-merit. And nuclear's picture is very mixed. The fleet, except Sizewell B, is getting very old, whilst Hinkley Point C is being built at tremendous expense. It won't be producing electricity for many years. And we've also seen recently is the advent of renewable generation, particularly over the last 3 or 4 years. It really has increased in terms of capacity and generated output. There are 7 major technologies, excluding nuclear. They are wind, hydro, solar, biomass, marine, geothermal, and fuel cells. But for the UK, onshore wind is key, and it's also true that solar power is really progressing in the south of England. And I think it's fair to point out that most UK renewables generation is either from the integrated players, established players such as SSE and Vattenfall from Sweden, or from the renewable energy infrastructure funds. The next slide shows classifications. We use the AIC, Association of Investment Companies classification, to look at the 21, what we call RIFEs, Renewable Energy Infrastructure Funds. There are quite a number of comparisons with the infrastructure investment companies, IICs. HICL, 3i, and BBGI are probably the most well-known, all have capitalizations over £1 billion. But the smaller renewable energy infrastructure grouping, 21 companies, including Harmony Energy, that was quoted very recently for the first time, and Pantheon Infrastructure, whose quotation started just last Tuesday. The sector for the RIFEs, 21 of them now, is worth over £14 billion. And the focus really is onshore wind. That drives the numbers. There are also 3 quoted solar RIFEs. And increasingly, particularly over the last year or so, battery storage development has become of great interest to investors. Looking forward, offshore wind will certainly be very important indeed, particularly for Germany, you have to say, with the Baltic area being very attractive, and the fact that Germany will be closing down all its nuclear power stations fairly shortly. So offshore wind will see a very large investment. As for the 21 RIFEs in the UK, most operate in the UK, wind plants and so forth. Many are expanding into the European Union, and some have US operations. Indeed, some are actually US based. The 2 leading funds in the 21 strong sector are TRIG, the renewable energy company. That has a market capitalization of about £3 billion. And in addition to that, there is Greencoat UK Wind, which has the second highest market capitalization, £2.6 billion. What's in it for investors? Well, first of all, a strong defensive play. And during COVID-19, as we know, certain sectors were hammered, but not renewable energy infrastructure funds. Yes, in some cases, but indeed in most cases, there was a chasm in terms of share price in March 2020, but all have virtually recovered their losses, with a few exceptions admittedly. Investors also benefit from relatively predictable output levels, although it is true autumn 2021 there has been a lack of wind, which will, I suspect, appear in some companies' numbers over the next few months. It's also the case that there are substantial government subsidies, especially for solar investment. And we've seen since January 2020 a very encouraging fundraising record with close to £5 billion being raised over the last 22 months. For investors too, they will be comforted by impressive ESG credentials, and the companies are pretty upfront in publishing what they do in terms of ESG. I mentioned earlier the very resolute COVID-19 experience, and obviously contrast with the hammered aviation sector, hotel, hospitality, and so forth. Current prospective yields are around 5%, and for the bigger players, slightly higher than that. And the impressive total shareholder returns warrant mentioning. I put down on this slide TRIG, total shareholder return at 9.3% per annum since August 2013. That's, I would suggest, quite an impressive figure. Greencoat UK Wind, also on ESG, is very forward. If you look at their results presentation, you can see they list it very clearly what they're doing in each of the three branches of ESG. But like any investment, there are risks. Phasing out of subsidies is obviously a risk. And indeed, new solar plants no longer get subsidies post-2017, which has meant there's been a bit of a hiatus in solar investment. Low wind levels, as we've seen very recently, is a concern. Low power prices. Now, that probably will change, but certainly a year or so ago, year and a half or so ago, some of the funds had big hits because the net asset value is calculated over longer term power price projections going up to, shall we say, 15 years. And TRIG in particular had a hit to its net asset value of over £100 million. Dividend growth is also obviously a key issue. It may be curbed. In some cases, dividend has been held. And I think it's worth differentiating between nominal dividend increases, which we've seen with many of the funds, and most of them, and real dividend increases, which will be much harder to achieve given rising UK inflation. And it is the case that dividend cover for some funds is actually quite thin. I've quoted here Next Energy Solar being one that's thin, and also JLEN, the old John Lang Environmental Fund, that also is a bit thin. Adverse tax changes are always a concern. But I would say that the defensive elements also does limit share price growth. Comparisons to Centrica perhaps may not be too direct, but Centrica's share price has gone down roughly 2/3 over the last 5 years. And if Centrica had a really good run in terms of investor sentiment, clearly the share price increase would be considerably higher, I would imagine, than virtually any of the 21 RIFEs. I mentioned the fundraising had been quite impressive recently. 21 RIFEs securing £5 billion of new investments since January 2020. It is a very reassuring fundraising record. And in virtually every case, the money raised has been at a very low discount to the prevailing stock market quotation. Now, I accept that Capita may sound a bizarre comparison, given it's in the IT market rather than involved in energy. It is perhaps relevant to point out that Capita needed a 56% discount for its underwritten share fund raised back in 2018. And that's a very big discount, obviously, compared with the discounts we're seeing for the RIFEs. It's also fair to say, perhaps, that Capita's share price has actually fallen subsequent to that massive fundraising effort. We'll see a bit more from Greencoat UK Wind. They've got an equity issue going on at present. And when we've got full details of fundraising, but I'd be surprised if they had major problems in raising the money they want. And another very encouraging sign is Pantheon's infrastructure. Dealing started last Tuesday. They tried to raise £300 million. Their maximum they could raise was £400 million. And even on £400 million, they had to cut back some applications, so they didn't go over their ceiling. However, it's not all perfect. Some RIFEs have had to settle for lower proceeds than planned. And if you look at some of the prospectus figure aspirations for fundraising and what they actually raised some weeks later, there's a significant difference in certain cases. And we've actually had some outright failures, Blackfinch, for whatever reason, being one. The next two slides show the REC fundraising over the last 22 months, both in terms of new shares, the price, and the actual gross proceeds. But it's clearly a sector where fundraising, as the government tries to drive out new renewable investment, has been very successful, although almost by definition, some of the attempted fundraisers get less publicity than those actually that actually are successful. So those two slides just list what's happened over the last 22 months. In terms of conclusion, I think message number one, renewable power has certainly come of age over the last 4 to 5 years. It really has come of age, and we're talking about contributing in terms of output something like 30% of UK generation. And I would suggest that the Rife sector of the 21 funds is certainly worth assessment by discerning investors, particularly those looking for solid dividends. I accept the sector compared, shall we say, with a national grid or a central with quite low profile, but certainly the returns and so forth are attracting interest from potential investors. The defensive characteristics I have mentioned, given that a lot of it's dealt with on contracts, long-term contracts and so forth. And whilst achieving substantial real dividend growth will be tricky, the quest for secure nominal dividends is still out there. And obviously, people will make a lot of comparisons with the yield on 10-year gilts. I'm fairly certain that more IPOs will follow. After the last couple of weeks, we've had both Harmony Energy and Pantheon Infrastructure appearing. And I think also, whilst most of the focus will be on wind power, onshore, particularly in Scotland, and offshore, particularly in the Atlantic and in the Baltic, there's also increasing interest on battery storage. And it is significant that we have had 1 or 2 new funds really focusing on battery storage. There's a recognition that the reserve levels are so low that anybody who can devise schemes and systems to store renewable energy is onto a very, very good thing. It'll take time, but that is one of the areas really being chased by those battery storage funds. Having said that, I would now like to hand back to Richard, and I'm happy to take any questions if there are any.
Nigel, there are a number of questions. I'm going to start with a specific question from Paul. So this is to clarify something we talked about earlier. What is the extent to which the income flow of each of the quoted renewable energy investment funds is index linked?
Well, the first thing I should say is that dividend cover recently has got quite low for certain companies. But inflation generally is good for the companies, and the larger ones actually do publish charts showing if inflation went up by 0.5%, how much that would actually benefit their net asset value. I would say also that irrespective of inflation, there are other very pertinent impacts on the returns and cash flow of individual funds, particularly power prices. And a particular example came to mind as of yesterday, when Scottish and Southern Energy confirmed that wind speeds in Scotland in the last few months have been quite weak. That's bound to impact upon Greencoat UK Wind, which, whilst it may have quite a good cash flow, I suspect for 2021 will be adversely impacted by the lower wind speeds of recent months.
Paul's got a follow-on. Is it true that JLEN has the lowest level of indexation and Greencoat UK Wind, UKW the highest?
I can't give a precise answer on that, I'm afraid, because it's very complicated to work it all out. There are, say, various drivers on the valuations and indeed on the cash flow of the individual funds, some power price related, some inflation related. But I say they do all publish, at least the larger ones, publish inflation assumptions, which are actually different going right forward over a number of years. They do have different inflation assumptions, which also makes it more complicated.
This is an interesting question. Nigel, you've been in the markets for many years. What indicator would there be for the investor that the current fundraising have reached an unsustainable level?
I think, as is perhaps not surprising, investors get more and more discerning as more applications come to raise funds. I think on battery storage, it will be a case of not just battery storage, but why do you think a particular fund can actually do something really good? And if you can prove that, then you may find it relatively straightforward to raise funds. But just a more general viewpoint, we think battery storage is the thing to raise money for because national grids having problems keeping the lights on. That type of thing, in my view, wouldn't be good enough. I think on wind, which after all is the biggest consumer investment, in England, it is increasingly difficult because of the planning and so forth to get wind, or to get approval for wind investment onshore. This may well be changing. I think in Scotland, it's rather easier. And then, of course, the bigger one will be the offshore wind, and the amount of money involved will be vast. You may have seen the white paper and the pledge to get offshore wind increasing by 3 to 4 times over a decade. That will require a very, very great deal of money. And I think it would be brave investors initially who go into offshore wind. There are certain problems involved with offshore wind. And of course, the amount of money involved will be considerably more than the standard onshore wind. So we may see a lot of consortia, and we may see various deals with getting the wind ashore, whether with National Grid being closely involved. But you must remember, for offshore wind, the turbines involved are very, very much larger than onshore wind, and hence much more expensive. And indeed, I should add, they consume a very large chunk of the total investment.
Okay, so moving on to solar. Is UK solar viable without subsidies?
A very good question, and a question analysts do ask the 3 solar funds. It is true that 1 or 2 investments have been made post-2017 without subsidies. Nexen New Solar in particular has invested in, I think the capacity is 50 megawatt plant. I think the jury's been out on that. It does depend, A, on what sort of contracts they can get going forward for the output, and particularly, of course, on what price. So it's something we'll be looking at fairly carefully over the next 3 to 4 years. But it's fair to say that the level of solar investment since 2017, if you look at charts on that, is significantly lower than pre-2017, irrespective of COVID.
You touched very briefly on hydrogen, but there's a lot of people think that this could be a very big sector. What are your thoughts? I mean, we could look at this in the context of electric vehicles, for example.
I think it's a bit like battery storage. I think many major investors will say they want more details of precisely what is being planned by a particular fundraise. Is it putting hydrogen through existing gas pipes, for example? I think I'm right in saying some trial has taken place in Leeds to do that. Is it successful or not? There are various types of hydrogen, there are various possible uses and so forth. And I think it's something where you would need a real niche area saying we are going to deploy hydrogen to do A and B. And B, I think particularly with many renewable IPO presentations, many discerning investors want someone presenting who has got real technical knowledge about the particular area, whether it's hydrogen, whether it's battery storage, before they commit funds. And I think increasingly that will be the case.
Okay, I've got a question from Charles. It's a very specific question. It relates to the Rolls-Royce mini nuclear power plant project. Do you have any comments?
Yes, very interesting. It's not totally new. Rolls-Royce has been talking about this for many years. It's fair to say that the government has been appalled at the situation at Hinkley Point. 23 billion is the latest figure, probably going northwards, and timing is probably going to go further out as well. And the concern, particularly if Chinese investment is not allowed for future ones post Hinkley Point C, such as Sizewell and others, I think increasingly they will be looking at small reactors. What you have to remember, though, is reactors take a very, very long time to go through the approval process. It's extremely complex. And I always use the argument, if you were a senior civil servant approving plants like that, you have one word in your ears, Chernobyl, and real concerns that are any of these plants which are being submitted, are you absolutely certain that they're safe? And I think that's bound to cause delays and so forth. With regard to Rolls-Royce itself, it's not really a company I follow. I suspect some would say perhaps Rolls-Royce should really focus on the very difficult engine market rather than getting too involved in nuclear. But it may well be that they've got ways of getting around that. And it may well be they say, look, the amount of investment we're going to do is actually quite small. What we'll do is use our technical knowledge through our involvement in nuclear submarine technology to get that going without necessarily spending a vast amount of money from the Rolls-Royce account on it.
Okay, I think we've just finished with a more general question. What are the most favoured overseas markets for renewable energy funds?
Well, initially it was the UK wind and so forth. That was the market. And the two big ones, Trig and Greencoat UK Wind, did very different things. Greencoat UK Wind says we stay in the UK and we only do wind. Trig says well, we're going overseas, we're going to Europe, particularly Northern Europe, where wind is attractive, and we're doing a few things outside wind. So there's a big difference between the big two there and what they actually do. What we've seen recently is a number of funds launch which are cherry picking some of the best opportunities across Europe. And for example, Octopus is one, Octopus Renewables is doing that. And we've seen Aquila as another one. So cherry picking some of those areas, which tend to be wind in Scandinavia and solar in Southern Europe. That tends to be the focus. There are one or two American ones, perhaps rather different criteria apply, like US solar. But the bottom line is that we are seeing more and more of a pan-European approach, I think, rather than the basic Greencoat UK approach, which is we only know the UK, we only deal with wind, and judge us on that.
Nigel, thank you very much. It's been delightful chatting to you. I'm now going to hand back to Keith. Thank you.
Thank you, Nigel. So that concludes the presentations today. I'd like to thank our speakers and you, the audience, for attending this forum. Thank you very much.